Alright, welcome back. So today we're going to be talking about different investment strategies, and then I'm going to be going into my investment strategy in a little more detail. So without any messing around, let's just get into it. So the first thing to note is that there are 5 main investment strategies, and you should try and stick to the one that's right for you in order to get a feel for what a good stock may look like, and obviously then increase your chances of success. Having an investment strategy is like having an instruction booklet guiding you through the investment process. It will help you discard many potential investments that may perform poorly over time, or that just aren't right for your investment goals that you're looking to achieve. When creating an investment strategy, it's important to quantitatively figure out what you are seeking to accomplish. So simply stating that you want to make money or become wealthy is not helpful. A better objective would be to say, I want to achieve an 8% average annual return on my investment contributions over the next 10 years in order to amass £200,000 that will be used to purchase my next home. The more specific the objective, the better. So think smart. Specific, measured, achievable, realistic, and time-oriented. When choosing the right investment strategy, there are questions that need to be answered first. So, what is your investment time horizon? What returns are you seeking to achieve? What amount of risk are you willing to tolerate? What are the funds in this investment to be used for? And potentially other questions as well. Answering these questions will ultimately also help in building your portfolio. So, with that out of the way, let's move into the 5 different investment strategies. So the first investment strategy is value investing. So this is made popular by Warren Buffett, and the principle behind value investing is quite simple. Buy stocks that are cheaper than they should be. Value stocks will typically trade at a discount to either the price to earnings, book value, or cash flow ratio. Finding stocks that are underpriced takes a lot of research on the fundamentals of the underlying companies, and once you've found them, it often takes a long time for their price to rise. This buy and hold technique requires a patient investor, but should the right call be made, handsome payoffs could be earned. With value investing, you want to pay particular attention to the following metrics: price to book value, price to earnings, and the discounted future cash flow and discounted dividend models. To quote Buffett, "This is an all-important concept that offers the only logical approach to evaluating the relative attractiveness of investments and businesses." And to quote Lynch, "After all, does it make sense to invest at prices that reflect years of rapid earnings that may or may not occur?" The downside is, however, that you may miss out on some stocks that go on to perform very well because they don't quite meet your required rate of return, even at their trough prices, i.e. at their lowest prices. The second investing strategy is income investing. So many see income investing as a great way to build wealth over time, as the idea behind this strategy is to build a portfolio of securities that generally pay out returns on a steady schedule to give you, the investor, a passive stream of income. Bonds are the best known type of fixed income security, but the category also includes dividend paying stocks, exchange traded funds or ETFs, mutual funds, and real estate investment trusts or REITs. Fixed income investments can provide a reliable income stream with minimal risk, but the downside is that you may miss out on some well-performing stocks with lower risk to reward ratios because they don't pay a dividend and so are not eligible for the income investor's portfolio. The third investment strategy is growth investing. However, before that, I'm going to kind of put a parenthesis around faster growth investing. Inherent in value investing is, of course, some forecast earnings growth. However, this tends to be quite a conservative growth figure, like 2.5% a year, for example. Growth investing focuses on companies that exhibit signs of above average growth through revenues and profits, even if the share price appears expensive in terms of metrics such as price to earnings and price to book ratios. Earnings growth figures tend to be in the 20% to 40% range and are often even higher than that, and growth investors expect stock prices to subsequently increase to reflect this, in turn appreciating the investor's invested capital. This is reflected in growth stocks' high price to earnings and price to book ratios, as investors are not concerned about the earnings now, but more in the distant future. Peter Lynch is one of the biggest advocates of growth investing, like Warren Buffett is for value investing. This is a relatively riskier strategy, however, as growth investing metrics assume high earnings growth for several years in order to judge what price to pay for them today. And so if an event such as a coronavirus pandemic occurs, which affects these earnings, this could have more adverse effects on the returns of stocks than, say, from income or value investing. It's worth noting, however, that growth stocks have outperformed value stocks by about 20% in the last decade, and I will leave the link to an academic paper that was written by Cliff Asness down below, should you wish to read any more about this further. Now moving on to the fourth investment strategy, which is small cap investing. So this is fit for those looking to take on a little more risk in their portfolio. As the name suggests, small cap investing involves purchasing stock of small companies with smaller market caps, so market capitalizations, usually between $300 million and $2 billion. Small cap stocks are appealing to investors due to their ability to go unnoticed. Large cap stocks will often have inflated prices since everyone's paying attention to them. Small cap stocks tend to have less attention to them because A, investors stay away from their riskiness, and B, institutional investors, like mutual funds, have restrictions when it comes to investing in small cap companies. Small cap investing should only be used by more experienced stock investors, as they are more volatile and therefore difficult to trade. Moving on to the fifth and final investment strategy, which is socially responsible investing. So this is a portfolio that you build out of environmentally and socially friendly companies, while staying competitive alongside other kinds of securities in a typical market environment. In today's modern world, investors and the general public expect companies to maintain some social conscience, and they're putting their money where their mouth is. SRI, or socially responsible investing, is one path to seeking returns that poses a significant collateral benefit for everyone. Some of these strategies will of course overlap. So for example, it may well be that a good value stock is also a good income stock, as it pays a good dividend, and in turn is also a socially responsible stock, as the company engages in, let's say, renewable energy. But it's important to broadly stick to one strategy to maximize your success. Now, with all of the above in mind, my personal investing strategy is value investing, as I believe that is the one with the highest risk to reward ratio. This is because I believe value stocks, theoretically at least, have a lower level of risk and volatility associated with them than stocks relating to the other four investment strategies, as they are usually found among larger, more established companies, and even if they don't achieve my target price, they may still offer some capital growth, and these stocks also often pay dividends as well. If you contrast this with growth stocks, for example, which typically will be found with smaller companies, if they don't reach your price target, you will not only suffer less than expected returns, but also these smaller companies are more likely to get into financial difficulties and potentially become insolvent, because they won't have the resources that larger companies have, and because they will be looking to expand, they will also probably spend any earnings on expansion, and so will not pay investors dividends. In terms of determining the reward with value investing, i.e. the cash returns, as outlined before, you do this only making modest assumptions about growth, and further lowering your risk by being disciplined and only buying the stock at the price that will give you your required rate of return, based on these modest growth assumptions. Again, to contrast with growth investing, the assumptions are higher growth figures in the future, and so you pay a higher price based upon them, and they may well not occur. So with that out of the way, and now that I've explained my rationale behind choosing value stocks to invest in, I'm now going to go over the following 4 key criteria a stock must have for me to even consider buying in. I want a company to be highly profitable, I need to be able to understand the business, I need the company to have an economic moat, which is essentially just competitive advantages that cannot be easily taken away by competition, and I don't want a stock to be too expensive, but I'm willing to pay a fair price based on future free cash flow. To decide if a company is highly profitable, I tend to look at a few different metrics. So there's ROE, return on equity, ROA, return on assets, gross, operating and net margins, and essentially what you're looking for here is high numbers, and it's key to compare to the industry average to get a feel for how profitable the company is compared with its competitors. If a company is more profitable than its competitors, then it's a good sign, because A, you will, as the shareholder, of course, benefit from that, and B, it signals that the firm must have some kind of economic moat to be able to charge higher prices, and so yield higher profits. What you don't really want is a company with low margins, because that signals that it competes more on price, and so there'll be little scope for other competitive advantages, which might protect the business from competitors, like the quality, the brand name, and the prestige of the products it sells. And if the company competes on price, this will then of course mean that the earnings for shareholders will be limited. Now, in terms of understanding the business, this is important, because if you don't understand how the business generates earnings, then how will you know what macro and microeconomic factors might impact the earnings in the future, for good or for worse? An anecdote from Peter Lynch that I like to use is, if you can't explain what the business does and how it makes its money in simple enough terms to be able to explain it to a child, you do not fully understand what the business does, and you should not be invested in it. Of course, we'll all have our own individual areas of expertise, so if you're more of an economist, you may well fancy bank stocks, which may be too complicated for the scientist who will prefer pharmaceuticals, which will in turn be too complicated for the economist to understand. The point is to know what your competencies are and to stick to them to play to your investing strengths. Moving on to the third point of my criteria, you always want the company to have an economic moat, because if it doesn't, barriers to entry will be lower and competition can come into the market and affect the profitability of the company by either taking market share or, even in extreme cases, wiping the company out. It is therefore very important that you establish what competitive advantages the company has and why competition cannot just enter the market and steal market share. So take Nike for example. People tend to value the brand because of its association with quality and performance. So because of this, if you offer a sports consumer a non-brand shoe from Costco versus a more expensive shoe from Nike, they will generally pick the Nike shoe. This is an economic moat, and you have to make sure that your company has one. Now, moving on to the fourth point of my criteria, and in terms of paying a fair price, this is where things get slightly technical, so please bear with me. So the fundamental building blocks of stock valuation in value investing are the earnings of firms. Think of it this way: in contrast to a work of art or a high-end luxury good such as a Rolex, which can be bought for its own enjoyment as well as an investment, stocks only have value because of their potential cash flows, which stockholders expect to receive from their share of the ownership of the firm. So with this in mind, fundamentally I look to calculate what is called the intrinsic value of the business, which is defined as the discounted cash flow of the cash that can be taken out of the business during its remaining life. This can then be used to benefit shareholders in the four following ways: through payment of cash dividends, repurchase of shares at intrinsic value or less to increase each remaining shareholder's claim on earnings, retirement of debt, or reinvestment of these earnings for future growth, so long as the return on invested capital of that future growth investment will be higher than a cash dividend in the present. To calculate the company's intrinsic value, and so the price I'm willing to pay, I must first know or estimate what the free cash flows are expected to be going forward 10 years. This is key because free cash flow represents the cash available for the company to repay creditors or pay dividends and interest to investors by adjusting for non-cash expenses, changes in working capital, and capital expenditures. Maintenance capital expenditure, or CapEx, is how much it will cost to keep the business running moving forward. And from there, using the discounted cash flow model, you can then extrapolate free cash flow figures going forward to arrive at your overall intrinsic value figure once you've outlined your required rate of return. I tend to find analyst figures either on Yahoo Finance or simply Wall Street for the first 4 projected years, and then simply assume a realistic growth figure, so let's say 2.5% for instance, going forward, and then discount these cash flows back to the present. If I feel a stock is slightly riskier, I can then also adjust the required rate of return, which will then give me a lower price that I must pay to reflect that risk. And that, in a nutshell, is how I arrive at my intrinsic value figure. So that is my investment strategy put as succinctly as possible without leaving out too many details. And I hope you enjoyed the video, and if you want to see any more technical details about anything that I've talked about, leave a comment down below.